Welcome back to the NOSR Webs podcast, everybody. And before we get started, make sure you visit the links in the description below for some fantastic offers. They can help you survive and thrive in the crypto world no matter what. You know that feeling you get when you check your crypto portfolio? And it's more red than a Valentine's Day sale. We're talking about those dreaded bear markets. Those crypto winters can send shivers down even the most seasoned investor's spine.
You could say that. Bear markets can feel like that uninvited guest who just overstays their welcome.
Exactly. But before we start prepping for hibernation, we're going on a deep dive to learn how to not just survive, but potentially thrive during these icy market conditions.
What's fascinating is that while bear markets are often seen as a time of fear and uncertainty, they actually present unique opportunities.
Okay, I like the sound of that. But before we get into the strategies, let's make sure we're all on the same page. What exactly defines a bear market?
So in simple terms, a bear market is when prices drop by 20% or more from recent highs. This dip is usually accompanied by a prolonged period of low investor confidence.
All right, like that collective, oh no, everything's going down sentiment in the market.
Precisely. And we've seen this play out before in the crypto world. Bitcoin, for instance, experienced a drop of over 70% from its peak in 2021 to its lows in 2022.
Ouch, that's a pretty steep drop. So why should we be concerned about these bear market cycles?
Because understanding these cycles and having a game plan can make all the difference. It helps you avoid making impulsive decisions driven by fear, like panic selling at the worst possible time.
Tempting as it may be. So this isn't a one-time event. Crypto has weathered these storms before.
Definitely. Crypto has a history of these dramatic market cycles. We saw significant bear markets in 2014 to 2015, another in 2018, and the more recent one in 2022.
And just how bad do things typically get during these cycles?
Historically, we've seen market capitalization, the total value of all cryptocurrencies, decline by a significant 65 to 85% during these bear market periods.
Okay, now that is scary. And here's something else to chew on. Data shows that 94% of altcoins cryptocurrencies, other than Bitcoin, never actually recovered to their previous all-time highs after a bear market.
That's right. It really highlights the importance of strategic portfolio allocation, especially during those turbulent times.
Okay, so it's not just about riding out the storm. It's about making sure you're invested in things that can actually weather these cycles. So let's talk strategy. What are some data-backed ways to not just survive, but maybe even come out ahead during a crypto winter?
Well, one of the most effective strategies backed by research is portfolio diversification. Think of it as not putting all your eggs in one basket, especially a basket that might be prone to tipping over.
So what's the ideal basket spread for weathering a crypto storm?
Research suggests a specific allocation that has historically performed well during bear markets. The optimal portfolio consists of 40-50% in top market cap cryptocurrencies like Bitcoin and Ethereum, 30-40% in stablecoins, 10-20% in proven altcoins, and 5-10% in cash reserves.
Okay, break that down for us. Why those specific percentages?
Sure. Bitcoin and Ethereum are considered the bedrock of the crypto world. They have the largest market cap and have shown resilience during downturns, providing a level of stability.
Makes sense. What about stablecoins? Why such a large portion there?
Stablecoins are designed to maintain a stable value, usually pegged to a fiat currency like the US dollar. This makes them less volatile compared to other cryptocurrencies, allowing you to buy more when prices drop. It's like having dry powder ready to deploy when the market is having a clearance sale.
Smart. And I'm guessing that smaller allocation to altcoins is for those who like a bit more risk?
You could say that. While riskier, they have the potential for higher returns. Allocating a small percentage to altcoins with strong fundamentals essentially leaves room for growth potential.
Got it. And that little bit in cash reserves, that's our just-in-case fund.
Exactly. Having a small cash reserve provides a safety net for unexpected expenses, without having to sell your crypto at a loss. It's about balancing stability, opportunity, and a bit of calculated risk.
All right, so portfolio diversification. Check. What other tools can we add to our crypto winter survival kit?
Well, another tried and true strategy is dollar cost averaging, often referred to as DCA.
DCA. Rings a bell, but refresh my memory.
It's actually a simple concept. DCA involves investing a fixed amount of money at regular intervals, regardless of the price. So let's say you decide to invest $100 every week in Bitcoin. You do this whether the price is going up, down, or doing the sideways shuffle.
So you're basically averaging out your purchase price over time.
You got it. And the beta shows that DCA can be incredibly effective, especially during those volatile periods like bear markets.
Okay, I'm intrigued. Tell me more.
Research suggests that investors who used DCA during previous bear markets actually achieved 23% better average entry prices compared to those who tried to time the market.
Wow, 23%. That's significant. So DCA is like the tortoise in the crypto race. Slow and steady wins the race.
Precisely. It takes the emotion out of investing and helps you stay disciplined, which, as we all know, can be a challenge when you're watching those numbers bounce all over the place.
Okay, I'm starting to see the appeal of DCA. Less stress, more potential gains. Sign me up. But I'm guessing DCA isn't the only strategy in our bear market survival toolkit, right?
You are absolutely right. There are several other approaches that can help you not just survive, but capitalize on the opportunities a bear market presents.
Ooh, things are getting interesting. Don't go anywhere, folks. We're just getting started on our Crypto Winter Survival Guide. And before we move on, just a reminder to check out those fantastic offers in the links below. And we'll be right back after a quick message.
Welcome back to the NOSR Webs podcast. We're in the midst of our deep dive into surviving crypto winters, and I think things are about to get really interesting.
Before the break, we were talking about portfolio strategies and that DCA thing, dollar cost averaging. Honestly, I'm starting to feel a little more empowered, a little less intimidated by these bear market beasts.
That's the spirit. Knowledge is the best antidote to fear. Speaking of other approaches, let's explore a few additional tactics that seasoned crypto investors often use to not just survive, but potentially thrive in a bear market.
Hit me with them. What else can we add to our crypto winter survival kit?
Well, one classic strategy is hodling.
Hodling? That sounds more like a typo than a strategy.
You're not wrong. It's actually an intentional misspelling of holding, and it's become a bit of a mantra in the crypto community.
Okay, so it's the diamond hands approach. You just ride out the storm, believing in the long-term potential of your investment.
Exactly. If you truly believe in the underlying technology and the long-term value proposition of a particular cryptocurrency, then hodling through a bear market can be a viable strategy. But remember, this requires a lot of patience and conviction, not to mention a strong stomach for volatility.
Got it. Hodl on for dear life.
Yeah.
What else?
Another option is to explore staking and yield farming.
Now, those sound a bit more like something you do on a farm, not in the digital world.
True, the names might be a bit misleading, but these are actually methods of earning passive income with your cryptocurrency. Staking involves locking up a portion of your crypto to support the operation of a blockchain network, and in return, you earn rewards.
It's like putting your crypto to work for you, even when the market is down. I like it. What about yield farming?
Yield farming is a bit more complex and involves lending your crypto to earn interest or other rewards. Imagine it like being your own crypto bank, but hopefully with a better interest rate.
I'm listening. This is starting to sound like we can make some lemonade out of these crypto lemons.
Exactly. And then there's tax loss harvesting. This one's a bit more on the technical side, but it can be a valuable strategy for offsetting capital gains and minimizing your tax burden. Essentially, you sell assets at a loss to offset any gains you've made elsewhere, reducing your overall tax liability.
Okay, I'm already lost. I'm not sure I trust myself to do my own brain surgery, so maybe not my own tax loss harvesting either.
Probably a wise decision. It's always best to consult with a tax professional before making any major financial moves. The main takeaway here is that there are multiple strategies available. We encourage you to explore and find what works best for your individual circumstances.
So it's not a one-size-fits-all situation. You need to find your own bear market battle plan.
Precisely. And speaking of battles, we can't ignore the psychological aspect of bear markets. The emotional roller coaster can be just as daunting as the financial one.
Oh, absolutely. It's easy to get caught up in the fear and panic when everyone around you is screaming, "The sky is falling." It can feel like a crypto apocalypse.
That's where understanding the psychology of bear markets becomes crucial. During these downturns, a fascinating phenomenon occurs. Research has shown that a whopping 76% of retail investors, everyday people like you and me, tend to exit their positions within the first 30% of a market decline.
So they're basically cutting their losses and running for the hills at the first sign of trouble.
Essentially, yes. Fear takes over, and they make impulsive decisions that often lock in those losses. But here's the interesting part. Only 12% of investors manage to hold their positions throughout an entire bear market.
Wow, only 12%. So the vast majority of people are getting shaken out by the volatility. It makes you wonder if those who stay the course are just incredibly lucky, or if there's something more to it.
That's a great question. And the answer, according to research, is that successful bear market survivors tend to focus on the fundamentals rather than getting caught up in the hype or panic.
So they're not just blindly hodling. They're making informed decisions based on solid research and analysis.
Exactly. About 82% of those who thrive during these periods base their decisions on fundamental analysis, things like the underlying technology, the team behind a project, and the real-world applications of a cryptocurrency. They're looking beyond the price charts and really understanding what they're invested in.
That makes a lot of sense. If you believe in the long-term value, you're less likely to panic when things get bumpy. It's like trusting your GPS even when you hit a detour.
Precisely. Emotional control is a superpower in the crypto world, especially during bear markets. It's about staying calm and rational when everyone else is losing their heads.
Easier said than done, though, right? When you see your portfolio shrinking, it's hard not to freak out. It's like watching your favorite ice cream melt right before your eyes.
Absolutely. But remember, bear markets are cyclical. They've happened before and they'll happen again. And each time they do, they present a unique opportunity.
Opportunity? You mean besides buying low?
Well, that's certainly part of it, but there's more to it than just bargain hunting. Think of it this way. When the hype dies down and the market cools off, it creates a space for genuine innovation and development to flourish. It's like the calm after the storm where the real building begins.
You mean like a crypto spring cleaning?
Yeah.
A time to clear out the clutter and focus on what really matters.
You could say that. Data shows that developer activity actually increases significantly during bear markets. For example, during the 2018-2019 bear market, there was a 72% surge in developer activity. And even during the 2022 downturn, we saw a 58% increase in GitHub commits across major projects.
So while everyone else is panicking, the builders are busy building, laying the foundation for the next wave of growth.
That's a great way to put it. And here's another mind-blowing fact. 65% of successful crypto projects were actually founded during bear markets. It's like the saying, the best time to plant a tree was 20 years ago. The second best time is today.
Wow, that's pretty incredible. So these periods of perceived doom and gloom are actually fertile ground for innovation and future success. It's like a hidden forest growing beneath the snow.
Exactly. Think of it like a forest fire. It might seem destructive at first, but it clears out the underbrush, allowing new growth to emerge stronger and healthier. Bear markets are not just about surviving, they're about setting the stage for future growth.
Okay, that's a powerful analogy. So we've got our strategies, we're keeping our cool, and we're focusing on the long game. But how long do these crypto winters typically last? When can we expect the thaw?
Well, historically, the average time to reach new all-time highs after bottoming out is about 518 days.
Okay, so we're talking roughly a year and a half. That's a pretty long time to wait for the sunshine to return.
It can feel like an eternity, especially when you're in the thick of it. But there are certain factors that can influence the speed of recovery.
Like what? Give us some hope here.
Well, one key factor is continued development. Remember all that building we were talking about? Projects that keep innovating and delivering value during bear markets tend to recover faster, about 2.3 times faster than those that stagnate. It's not just about surviving, it's about thriving even during the downturn. Keep building, keep innovating, and you'll be ahead of the game when the market turns around.
So it's like a snowball effect. The more momentum you build during the winter, the faster you'll roll into spring.
Exactly. Another factor to watch for is user growth. Projects that maintain or even increase their user base during bear markets also tend to recover faster, about 3.1 times faster than those that lose users. If people are still using and believing in the product or service, it's a good sign that the project has staying power.
Makes sense. It's like a popularity contest. The projects with the most loyal fans will be the ones leading the comeback tour.
That's a great way to put it. So those are just a couple of things to watch for as you navigate these choppy waters, but there's one more crucial element we need to discuss: risk management.
Oh yeah, risk management. That sounds about as fun as a root canal, but I guess it's important.
It's absolutely essential, especially during volatile periods like bear markets. It's all about protecting your capital and minimizing potential losses. Think of it as wearing a helmet while snowboarding. You might still fall, but you're less likely to get a serious head injury.
Okay, I'm getting the picture. What are some key risk management practices our listeners should be aware of? How do we put on our crypto helmets?
One of the most important is position sizing. This simply means determining how much of your capital you're willing to risk on any given trade. Successful bear market survivors tend to limit their position size to 1 to 3% per trade. It's like diversifying your snacks. You don't want to put all your chips in one bag, especially if you might drop the whole thing.
So not putting all your eggs in one basket.
Exactly. Diversification is key. But even within a diversified portfolio, you want to limit your exposure to any single asset.
Makes sense. What else?
Another important practice is using stop-loss orders. This is a predetermined price at which you'll automatically sell an asset to limit your losses.
So it's like a safety net. You're basically saying if the price drops to this point, get me out.
Precisely. It helps you take the emotion out of trading.
Yeah.
And prevents you from making impulsive decisions when the market is moving against you. Successful traders often set their stop-loss orders at 15–20% below their entry point. Think of it as setting a budget for your crypto shopping spree. You don't want to overspend just because everything is on sale.
Okay, that makes sense. What about just having some cash on hand, like a reserve fund? Is that a good idea?
Absolutely. Maintaining a capital reserve is crucial. Seasoned investors recommend keeping at least 50% of your capital in reserve during bear markets. It's like having an emergency fund for your crypto portfolio. You never know when you might need it.
Wow, 50%. That's a pretty significant chunk of change. I'm starting to realize that bear market survival is all about preparation and discipline.
You got it. And finally, regular portfolio rebalancing is essential. This involves adjusting your asset allocation as market conditions change. It's like giving your portfolio a regular tune-up, making sure everything is running smoothly.
And how often should you do this rebalancing? Is this like an annual checkup or more frequent?
Experts recommend rebalancing every 30 to 45 days. It helps you maintain your desired level of risk and ensures that your portfolio is aligned with your investment goals. Think of it as keeping your crypto ship on course, even when the seas are rough.
Okay, all this talk about risk management is making me feel a little more secure, but also a little overwhelmed. It's a lot to keep track of.
I understand. It can feel like a lot, especially if you're new to the crypto world. But the key takeaway here is that risk management is essential. It's about protecting yourself and ensuring that you're in the game for the long haul. It's about being a smart and savvy crypto sailor, navigating those choppy waters with confidence.
I like that analogy. So we've covered portfolio strategies, emotional resilience, the power of innovation during downturns, and the importance of risk management. But there's one more thing I'm curious about: institutional involvement. We've heard a lot about big institutions getting into crypto, but has that changed now that the market is down? Are the big players still in the game, or have they abandoned ship?
That's an excellent question. And what's fascinating is that despite the 2022 bear market and the price drops, institutional involvement actually increased significantly.
Really? That's pretty surprising. You'd think they'd be running for the hills. Just like those retail investors we talked about earlier, maybe they know something we don't.
It's possible the data tells a different story. Institutional holdings actually increased by 87% during that period. They're not just dipping their toes in the water, they're diving in head first.
Wow, 87%. That's a huge vote of confidence, even in a bear market.
It certainly is. And it's not just about holding crypto. Corporate treasury Bitcoin holdings, meaning companies adding Bitcoin to their balance sheets, also grew by a staggering 269%.
Okay, now that's impressive. It seems like these big players are seeing something that the average person might be missing. Maybe they have a crystal ball that shows them the future of crypto.
Maybe they do. And here's another interesting tidbit. Institutional trading volume, the amount of crypto being traded by institutions, represented 84% of the total market volume during that time.
So they're not just testing the waters, they're making some serious waves.
Exactly. And even venture capital funding the money being poured into new crypto projects reached a whopping $30.3 billion in 2022, despite the bear market. So all signs point to continued institutional interest, even when the market is down. It seems they're not just weathering the storm, they're building arcs.
Wow, so maybe these bear markets aren't something to be feared, but rather a natural part of a maturing market. A time for the strong to get stronger, and for the savvy investors to position themselves for the next big wave.
That's one way to look at it. And as the market matures, we're seeing other indicators of positive development.
Like what? Tell us more. I'm feeling optimistic.
Well, for one, volatility is decreasing. Each bear market cycle seems to be a bit less volatile than the last. With a decrease of about 12% per cycle, the wild price swings are becoming less extreme.
So the crypto roller coaster is getting a little less bumpy. I can handle that.
Exactly. And we're also seeing increased correlation with traditional markets. This means that crypto is becoming more integrated into the global financial system. It's like crypto's graduating from college and entering the real world.
But isn't that a bad thing? Doesn't that make crypto more vulnerable to the ups and downs of the stock market? What happens if the whole system catches a cold?
It's a double-edged sword, for sure. But increased correlation also means increased legitimacy and acceptance by mainstream institutions. It's like crypto is finally getting invited to the grown-up table.
So it's a trade-off.
Yeah.
Gain stability, but potentially lose some of that Wild West appeal that drew many people to crypto in the first place.
Exactly. But overall, the trend seems to be towards greater stability and integration. And speaking of stability, market depth has also improved significantly by about 156% during the 2022 bear market.
What does market depth even mean? Is this like the deep end of the crypto pool?
It's basically a measure of liquidity. A deeper market means there are more buyers and sellers, making it easier to buy and sell assets without causing drastic price fluctuations. It's like having a wider pool to swim in, less chance of getting splashed around by a big whale making a sudden move.
That's a great analogy. So more liquidity means more stability and less chance of getting wiped out by a rogue wave.
Precisely. And finally, we're seeing significant progress in the development of regulatory frameworks.
Ah, yes, regulations. The word that strikes fear into the hearts of many crypto enthusiasts. But maybe it's not such a bad thing after all.
I understand the sentiment, but regulations are actually a good thing in the long run. They provide clarity, protect investors, and help foster a more stable and trustworthy market. It's like building a fence around the crypto playground. It keeps things safer for everyone involved.
So it's about finding that balance between innovation and regulation, allowing the crypto spirit to run free while still keeping things safe and sound.
Exactly. And the data shows that regulatory framework development has increased by a whopping 234% in recent years.
So governments are taking crypto seriously, and that's likely to continue as the industry grows.
Absolutely. So as you can see, there are many positive developments happening beneath the surface of these bear markets. It's like a hidden forest growing beneath the snow.
You just have to know where to look. This has been an incredibly insightful deep dive so far. I'm feeling much more confident about facing whatever the crypto market throws my way.
That's fantastic to hear. And remember, knowledge is power. The more you understand, the better equipped you are to make informed decisions and achieve your financial goals.
Well said. We've covered a lot of ground today, but before we wrap things up, I'm sure our listeners are eager to hear your final thoughts on how to not just survive, but thrive in these crypto winters. What's the ultimate takeaway message?
Absolutely. Let's recap and offer some concluding insights. Bear markets are a cyclical phenomenon in crypto. They've happened before, and they'll happen again. Understanding their nature empowers you to make informed decisions rather than reacting out of fear.
Right, so don't panic. These winters eventually thaw, and the market has historically rebounded stronger each time.
Precisely. And remember, a combination of strategic portfolio management, emotional discipline, and a long-term perspective is key to not only weathering the storm, but potentially positioning yourself for significant gains when the market recovers.
It's like that saying, the best time to plant a tree was 20 years ago. The second best time is today. Even in a bear market, there are opportunities to plant those seeds for future growth.
That's a wonderful analogy. Here's a final thought for our listeners to ponder. While bear markets can be intimidating, they also offer a chance to reevaluate your investment strategies, refine your portfolio, and perhaps even discover hidden gems that might have been overlooked during the hype of a bull market.
So it's a time to sharpen your skills, do your research, and get ready for the next wave of opportunity.
Exactly. And remember, the crypto world is constantly evolving. What works in one market cycle might need to be adjusted in the next. Stay curious, stay informed, and never stop learning.
Couldn't have said it better myself. This has been an amazing deep dive, and I feel much more confident about facing whatever the crypto market throws my way. And don't forget to visit those links in the description below for some amazing offers that can help you survive and thrive in the crypto world no matter what. We'll catch you on the next deep dive.